This isn't a random bad quarter for a few unlucky companies. When logistics firms start issuing mass layoff notices all at once, that's an alarm bell for how the economy actually works underneath the press releases. Logistics is not a luxury sector. It's the circulatory system. When warehouses, freight brokers, trucking companies, and third-party logistics providers start cutting thousands of workers, it tells you that goods are not moving the way they used to. And more importantly, that the people who control capital expect that slowdown to last. California feels this faster and harder than most states for a simple reason. It sits at the choke points of global trade: ports, rail hubs, inland distribution centers, trucking corridors, massive warehouses in the Inland Empire and Central Valley. This is where imported goods become domestic commerce. When volumes fall, California workers are the first to notice. When companies decide they overbuilt capacity, California is where they reverse course. That's why these layoffs immediately become political. A logistics layoff is not some abstract market correction. It shows up as thousands of middle-income jobs disappearing in clusters, often in regions with few comparable alternatives. It hits unionized workers and non-union workers alike. It hits tax bases, it hits local service economies, and suddenly the governor is no longer talking about long-term growth or climate leadership. He's answering questions about why people with steady jobs 6 months ago are now filing for unemployment. The official story from companies is predictable. They say demand normalized. They say the pandemic distorted the market. They say they're right-sizing after an unusual boom. All technically true, but completely incomplete. The real issue is that logistics firms made expansion decisions based on a short-term profit surge, not on stable long-term demand. They built warehouses, hired aggressively, locked in equipment, and took on debt assuming high volumes would continue. When interest rates rose and consumer spending slowed, the easiest cost to cut wasn't executive pay or shareholder distributions. It was labor. Now here's where the pressure lands on the governor. California has higher labor standards, stricter environmental rules, and higher operating costs than many competitor states. That's not an accident. Those policies were chosen deliberately, often for good reasons. But when the cycle turns downward, those same rules change the math for companies deciding where to absorb losses. Firms don't leave California because profits disappear entirely. They leave because profits shrink, and they go looking for places where shrinking hurts less. This is where the debate gets distorted. Critics say California is anti-business. Supporters say companies are greedy and disloyal. Both miss the mechanism. Capital is mobile. Workers are not. When margins tighten, firms adjust by moving capital and cutting jobs, while states are left managing the fallout. That's not a moral failure. It's how the system is designed to function. So when logistics layoffs accelerate, the question isn't just how many jobs were lost. It's what phase of the cycle we're in, and who is positioned to absorb the shock. Are we looking at a temporary downturn that reverses when rates fall? Or are we seeing the end of a logistics model built on cheap money, global overcapacity, and just-in-case inventory strategies? Because if this is structural rather than cyclical, then the governor isn't facing a messaging problem. He's facing a collision between California's economic model and the realities of global capital. And that collision is only beginning to show up in the numbers. To understand why the layoffs are happening now, you have to rewind to the pandemic boom and look at how distorted incentives became. Between 2020 and 2022, logistics was treated like a guaranteed growth industry. Lockdowns shifted consumption online, stimulus checks kept demand high, and supply chain bottlenecks pushed shipping rates, warehouse prices, and freight margins to historic highs. Executives didn't see this as a temporary spike. They treated it as a new baseline. So they expanded aggressively. Warehouses were built at a pace that would have seemed reckless a decade earlier. Trucking fleets grew. Third-party logistics firms hired planners, dispatchers, sales teams, analysts. Venture capital flooded into logistics tech startups promising efficiency and visibility, all assuming permanently high volumes. Cheap money made it easy. Interest rates near zero meant borrowing felt almost free, and investors demanded growth above all else. But that entire expansion rested on one fragile assumption, that consumer demand would stay elevated. It didn't. As inflation rose, households pulled back. Goods spending fell faster than services. Retailers were left sitting on excess inventory, which meant fewer new orders. Fewer orders meant fewer containers, fewer truckloads, fewer warehouse shifts. Logistics doesn't decline gradually. It falls off a cliff once volume drops below capacity. That's the key mechanism. Logistics is a fixed cost heavy business. Warehouses, vehicles, software systems, long-term leases, these don't shrink easily. When utilization drops from, say, 90% to 70%, profits don't just fall 20%. They can disappear entirely. At that point, companies scramble to cut variable costs as fast as possible. Labor is the biggest one they can touch quickly. Now add interest rates. Rising rates didn't just slow consumer demand, they raised the cost of carrying excess capacity. Suddenly, that warehouse financed with cheap debt is a liability. Suddenly, investors care less about growth stories and more about cash flow. Executives who were rewarded for expansion are now rewarded for cutting. Same firms, same leadership, opposite behavior, because the incentive structure flipped. Notice what didn't happen. Companies didn't voluntarily absorb losses to preserve jobs. They didn't shrink shareholder payouts first. They didn't meaningfully cut executive compensation. Those costs are politically and contractually protected. Labor isn't. So layoffs become framed as discipline, efficiency, or right-sizing, even though the underlying problem was strategic overexpansion driven by short-term profit chasing. California workers feel this acutely because so much of that expansion was geographically concentrated. Inland warehouse hubs, port-adjacent logistics zones, and trucking corridors grew precisely because companies wanted to be close to volume. When volume evaporates, those same regions become layoff hotspots. What looked like smart clustering during the boom becomes concentrated pain during the bust. This is where executives and politicians talk past each other. Executives say, "We're adjusting to market reality." Politicians say, "We need better worker protections." Both statements can be true and still miss the deeper issue. The boom was never designed to be stable. It was designed to extract profits quickly under extraordinary conditions. When those conditions ended, the business model offered no protection for workers. And that's why calling this a normalization is misleading. Normal would imply a return to balance. What we're seeing instead is a violent correction from an unsustainable peak. The question isn't whether logistics will continue to exist. It will. The question is whether the jobs that were created during the boom were ever meant to be permanent in the first place. Once you see that, the layoffs stop looking like a surprise and start looking like the predictable outcome of a system that privatizes gains during the upswing and socializes losses during the downturn. And that sets up the next problem: how state-level policies, especially in California, interact with that reality and shape where companies decide to cut first and hardest. Once the boom collapsed, the question for logistics companies was not whether to cut, But where? And this is where California's role becomes unavoidable. Firms operate across multiple states. They have options. When profits tighten, they don't distribute pain evenly. They concentrate it where costs are highest and political resistance is weakest. California often sits at the center of that calculation. Start with labor. California has higher minimum wages, stronger overtime rules, stricter worker classification laws, and more aggressive enforcement than most states. For workers, these protections matter. They raise incomes and reduce abuse, but from a firm's perspective, they also raise the marginal cost of keeping each employee during a downturn. When volume falls, the incentive is not to preserve jobs at a loss, but to shed them quickly where each job costs the most. Then there's the regulatory environment, environmental rules, emissions standards, fuel requirements, and reporting obligations add layers of cost and complexity for logistics firms operating fleets and large facilities. Again, these policies were adopted intentionally, often to correct real harms. But when revenues drop, compliance costs don't shrink with demand. They stay fixed. That pushes companies to consolidate operations in states where rules are looser and enforcement less aggressive. Energy costs amplify this dynamic. Logistics is energy intensive. Warehouses require power. Trucking depends on fuel. California's energy prices are structurally higher than the national average, and volatility adds uncertainty. During boom times, firms absorb those costs. During busts, they look for ways to avoid them. That often means cutting shifts, closing facilities, or redirecting volume elsewhere. What's crucial here is that companies rarely frame these decisions as California is too expensive. They talk instead about efficiency and optimization. But efficiency in this context means reallocating activity toward jurisdictions that extract fewer obligations from capital. That's not ideology, it's arithmetic. When margins shrink, firms don't debate values. They follow spreadsheets. Now look at who bears the adjustment costs. Workers lose jobs. Local governments lose tax revenue. Communities built around logistics hubs lose stability. Meanwhile, shareholders are insulated, and executives are often rewarded for decisive cost management. The losses are localized. The gains remain mobile. Supporters of California's model respond by saying the state shouldn't engage in a race to the bottom, and they're right. Competing by gutting labor standards would simply shift harm from workers today to workers tomorrow. But critics who argue that regulation has no role in corporate decisions are also wrong. Firms respond to incentives. Ignoring that doesn't make it go away. This creates a structural bind for the governor. Loosening protections risks alienating labor and undermining the state's social commitments. Holding the line risks accelerating job losses in cyclical downturns. There is no painless option within the existing framework. That's why state responses tend to focus on mitigation rather than prevention. Warn notices, retraining programs, transition assistance, tools that manage the aftermath rather than altering the underlying dynamic. The deeper issue is that California is trying to regulate capital that can move freely while workers cannot. That imbalance means every downturn becomes a test of how much pressure the state can absorb before firms redirect investment elsewhere. Logistics just makes this visible sooner than other sectors because it's so sensitive to volume shifts. And that brings us directly to the political problem facing the governor. How to maintain a pro-worker identity in a system where protecting workers often means watching companies walk away and then being blamed for the consequences. This is where the pressure on the governor becomes personal and political. On paper, the response looks active. Stronger WARN requirements, retraining funds, workforce development programs, coordination with local agencies. These are presented as proof that the state is standing with workers. But structurally, they all share the same limitation. They intervene after the decision to lay off has already been made. WARN laws don't stop layoffs. They manage the optics and timing of them. Retraining programs don't preserve jobs. They shift responsibility onto workers to adapt to decisions they didn't cause. That's not nothing. Advance notice and support matter, but it's fundamentally defensive. It accepts capital's freedom to move as a given and focuses on cushioning the blow rather than challenging the rules that made the blow inevitable. This puts the governor in a bind that can't be resolved with better messaging. On one side, business interests argue that California's costs and regulations are driving firms away. On the other, labor groups demand stronger enforcement, more protections, and public accountability for companies that cut jobs after years of profits. Both sides are responding rationally to their incentives. The governor has to navigate between them without control over the underlying leverage. That's why the politics often turn symbolic. Announcements about worker protections, task forces, and future-oriented investments stand in for direct power over corporate decisions. The state can penalize firms for non-compliance, but it cannot force them to expand, hire, or stay. When layoffs happen, the governor is expected to respond as if he personally caused or could personally prevent them, even though the real drivers sit in boardrooms responding to global demand and financial conditions. This tension intensifies because California's leadership has national ambitions attached to it. Every economic disruption becomes part of a broader narrative war. Opponents point to layoffs as evidence that progressive governance doesn't work. Supporters counter that these same companies thrive on California's infrastructure, workforce, and markets when times are good. The layoffs become less about logistics and more about ideology. But ideology doesn't explain why the same firms that expanded aggressively under California's rules are now shrinking under those same rules. Incentives do. During the boom, profits were high enough to tolerate higher standards. During the bust, they're not. That's not a failure of regulation in isolation. It's a failure to align worker security with investment decisions in a system that prioritizes capital mobility. This is why the governor's responses feel reactive. He's managing consequences in a framework he didn't design and can't easily change at the state level. He can't control interest rates. He can't control global trade flows. He can't stop companies from overexpanding during bubbles. But he's held accountable when the bust arrives. And that accountability gap matters because as long as layoffs are treated as unfortunate but unavoidable events, the political debate will stay stuck on how to soften the landing rather than how to redesign the plane. Logistics layoffs are exposing that gap clearly, and they're doing it at a moment when voters are less patient with explanations that boil down to the market decided. Which raises the final question. If this is how the system behaves under stress, what does it mean for the regions, workers, and revenue bases built around logistics? And what happens next if demand doesn't rebound the way executives hope? When logistics layoffs ripple outward, the damage doesn't stop at the company gate. Ports lose throughput. Trucking corridors see fewer loads. Warehouse towns lose not just jobs, but sales tax revenue, property stability, and public services funded by that activity. Places built around constant movement, containers, pallets, shifts running 24 hours don't downshift smoothly. They stall. And when they stall, local governments are left with fixed costs and shrinking budgets. This is the quiet risk California faces. Logistics has functioned as a backbone industry for regions that never fully recovered from deindustrialization. Inland warehouse hubs replaced factories. Port-adjacent jobs replaced unionized manufacturing. These were never perfect substitutes, but they provided scale and stability. If logistics becomes more automated, more consolidated, and more footloose, those regions face another round of economic hollowing. And automation matters here. When demand returns, companies will not rehire the same way they hired before. The lesson executives take from this downturn is not don't overexpand, but expand with fewer workers next time. More software, fewer humans, more temporary labor, less commitment. That means layoffs become semi-permanent even if volumes recover. The jobs don't come back in the same numbers or with the same security. This exposes the deeper problem with California's growth model as it currently exists. The state relies on high productivity, high profit sectors at the top, and large employment sectors like logistics to absorb workers in the middle. When those middle sectors destabilize, inequality widens, and political pressure intensifies. You can't retrain everyone into tech or professional services, and not everyone displaced from logistics is being transitioned into something better. So what happens next? If consumer demand stays weak and global trade remains volatile, logistics will not be the last sector to feel this pressure. Manufacturing tied to goods consumption follows. Energy and transportation follow. Retail follows. Each wave reinforces the same pattern. Capital adjusts quickly, workers adjust painfully, and states absorb the blame. The unresolved question is whether California, and the U.S. more broadly, is willing to confront that imbalance directly. As long as worker protection is treated as something separate from investment decisions, layoffs will remain the primary adjustment mechanism. As long as capital can chase the lowest friction while labor stays put, every downturn will look like this one. That doesn't mean the state should abandon its standards. It means standards alone are not enough. Without tools that tie job stability to corporate expansion, public subsidies, and long-term commitments, the cycle repeats. Boom, overbuild, bust, layoffs, mitigation, and then another boom. Logistics is simply showing us the pattern early and clearly. The question is whether anyone in power is willing to admit that managing layoffs is not the same as preventing them, and whether the next crisis will force that conversation or bury it under another round of right-sizing announcements.